Hello, everybody, and thanks for joining. It is 11 on the dot. I'm going to give it just a couple of more minutes for people to jump on in case there's anybody that's running a couple minutes late, and we will start sharply at 11:03.
To sit in an office and have no distractions.
And for those of you just jumping on, we're going to start at 11:03 just to give people a few minutes to get logged in if they're having any troubles. Can you guys that are on, can you see my screen where it says new products, bridge loan, and manufactured home one-time close? I get a nod. Awesome. Thank you. All right, well, it is 11:03, so I'm going to go ahead and dive in and get started. First off, thank you guys, all of you who are on right now. I'm excited to go over some of these new products. It's always exciting when there's new loan products on the market, but for me, it's specifically exciting when they're unique to Summit Funding. And both of these first two products are very unique to Summit Funding. And so I'm going to go through this, and at any time, if you've got questions, raise your hand or even unmute yourself and just speak up. It's hard kind of to do the presentation and monitor chat and so forth. So I don't think there should be people on here. I don't think there should be any issue if you just want to unmute yourself and ask a question. So I'll go ahead and dive in and get started. The two primary programs we're going to go over are our bridge loan program and our manufactured home one-time close construction program. I know that's a mouthful. I'm still figuring out how to refer to that program without saying so many words. I think we're going to call it our OTC for one-time close program. But and then I also have a couple bonus programs at the very end that we'll go over briefly as well. So we are going to start with our bridge loan program. Got a nice little bridge there. So first off, what is a bridge loan? And what's the purpose of it? So the purpose of the bridge loan is to provide financing options for borrowers who need to use the equity in a departing residence that they intend to sell towards the purchase of their new owner-occupied home. Why is this important? Well, what we find is that a lot of borrowers, even that have equity in their home, they don't think far enough in advance of buying their new home, right? So they could potentially do a refinance and pull some of that cash out, or go get some sort of line of credit against their current home before they go shopping for homes. But as I'm sure you all experience a lot, what happens is a borrower sees the home they love and they decide they want to make an offer on it, and they've done very little of the legwork going into that. And so at the point they're going into contract on a new home immediately, they can't then also simultaneously get financing on their current home, because it's a violation of lending rules. You can't have two primary residences at once, and you can't get a home equity line or a refinance on the house that you intend to sell shortly. So this is a product that gives the ability to do that. So we will actually lend on the home they're going to be moving out of, knowing that they're going to be moving out of it, and let them use those funds for the purchase of the new home. So why use it? Provide that solution for borrowers who are looking to purchase a new home and make their offers as competitive as possible. Assist by removing possible contract contingencies that may include the requirement to sell their existing home in order to use the equity for their new purchase. So that's the second piece of it, which is being able to write that contract without that sale of a home contingency. So how does it work? Two different options. The first option is the debt qualifying bridge loan, and the second one is the easy close bridge loan. I think you'll find that the easy close bridge loan is a more attractive option for borrowers who will qualify for it. And so we'll go through both of them so you kind of understand how they work. The big difference between the two in what drives which one they're qualifying for doesn't have anything to do with credit or anything like that.
Yeah, what's going on?
The sales status of their departing residence is the biggest one. And what that affects is how we calculate the debt to income ratio for them. So the first one, the debt qualifying, if the home is listed for sale, but is not sold, not in contract yet, not in escrow yet, the home has to be listed within 10% of the value that we appraise that home at. So we have to do an appraisal. It's an automated appraisal. It's not a full-blown appraisal. It's on the computer, but the home has to be listed within 10% of that value. And we must include the payment, both the regular mortgage payment and the bridge loan payment, in the qualifying. So the borrower has to be able to qualify for both payments. And the bridge loan will go to a maximum of 70% of the loan to value on that home. So an example of that, if someone has a house that they owe $300,000 on and it's worth $500, 70% of $500 is $350. And since they owe $300, there would be about $50,000 available for a bridge loan. So that's the debt qualifying option. That's the less attractive of the two. The more attractive option is the easy close option. And this is for borrowers whose home is in contract, or who you believe as an agent it can quickly be put into contract, and the buyer has released all of their contingencies. So the great thing in this market is it's not that uncommon to get a contract that either has no loan contingency or has very short loan contingencies. And so as long as the buyer has their home in escrow and has contingencies released, we don't have to hit them for payments on either their current loan or the bridge loan that we're going to give them. Also, it allows us to lend up to 80% of the loan value. So using that same scenario as before, if the house is worth 500 and they owe 300, they 80% would be 400. They'd be able to get $100,000 on their bridge loan, and we would not have to hit them for either payments. Also on this, all we need is for the loan contingency on the sale of their home to be removed sometime prior to close of escrow on the new purchase. So it doesn't have to be removed right when we go into contract on the new purchase, just has to be removed prior to close of escrow on the new purchase. And then we can eliminate the need to qualify with both houses or with the bridge loan payment. Some details that apply to both options. So first off, the bridge loan is for 120 days. The loan is due and payable at the end of 120 days. Again, the point of this product is basically to allow someone to buy without selling their current home. Summit Funding does not want to be in the second mortgage business. That's not something we want to do long term. We're lending our own money and we're doing it to facilitate these transactions, not because we want to hold anybody's note on a second mortgage. The second piece is the interest rate is only 5.99%, which is actually pretty low by second mortgage standards and by bridge loan standards. Again, designed to be short term. There is a 1.5% origination fee on the bridge loan. So it sounds like a lot, but it's not. On a $100,000 bridge loan, it's $1,500. That covers all of the costs for originating the loan. There's no monthly payments are made on the bridge loan, no matter how it's set up. Even if we have to qualify someone with a monthly payment, we don't actually collect any monthly payments. The new purchase loan that they're getting must have Summit Funding as the lender, and it must be a conventional loan. So FHA, VA, and jumbo on the new purchase aren't going to be eligible for it. Those type of loans typically aren't in need of a bridge loan as often, and the reason for that is they're all typically low down payment options. So at least FHA and VA are, so they don't necessarily need a big bridge loan to make them work. There's a 680 minimum credit score for this product. The bridge loan amount has to be between 50 and 100,000. So that's the minimum and the maximum on the bridge loan. And then the title can't be held in an LLC, trust, partnership, UCC filing, and there cannot be a UCC filing on the house, and there cannot be an existing second mortgage. So this product can't go in third position behind a solar lien or behind a current home equity line of credit. Before I go on to the next product, are there any questions about the bridge?
Yes, I wanted to ask, what is, I'm just a little surprised about the property being in a trust and not being able to do that.
Yeah, and I don't know why the trust, usually revocable trusts are not a big deal. This product, to get it approved, has we had to jump through a lot of hoops. So we're lending, we're backing it with our own money, but we have warehouse lenders that we fund these on, and the warehouse lenders had some very specific requirements. So most of what you see here was driven by the warehouse lenders. Keep in mind though, that we're doing this on a home that's going to be sold in a matter of weeks or months. So yes, we would, when we recorded, it would have to be recorded in the individual's names personally.
So then, can I interrupt? If if it was in a trust and they took it out of the name of the trust, put it in the name of the trustee, would you then be able to do it?
Oh, absolutely.
Okay, so they just have to do that step in advance. I've never walked through
No,
that.
they don't even have to do it in advance. It's just when we record this, we would record it in their names individually.
Blake, I missed the few minutes when you started. Is this program only for conventional non-occupied?
So this
Owner occupied.
the purchase of the new home has to be an owner occupied purchase.
Okay, but no FHA or VA.
But not, yeah, it's got to be a conventional owner occupied purchase. And Valerie, just to clarify on the trust, they don't have to do anything with the current title on that property. It's just this new lien is going to be in their names personally. It's not going to be in the names of the trust, but they don't have to make any changes to the existing title.
Okay, that sounds good.
So yeah, and just one more time to clarify that. So this is a loan on the borrower's current owner occupied property that they intend to sell. And it is a short-term loan, so it's not something they want to get if they intend to hold on to that property as a rental long-term.
So then if it needs to be a conventional buyer, can you still work with the ones like we have that program for 5% down first responders and what have you with another company?
Yeah, so we can still work with certain programs, although again, this is designed for someone, I mean, in this case, they're gonna have at least $50,000 for a down payment, and they're not going to be a first-time home buyer if they're using this
Yeah, it's
program,
not the same
so.
program. You're correct.
Yeah.
So what percentage in order to qualify as conventional, would they would be a conventional buyer? Well, primarily because they're selling their home, they'll end up with enough equity out of that to probably have what, like 20% down minimum or something in regards to
Maybe,
that.
I mean, 50,000, the conventional loan limit right now is 548. So realistically, they could put 10% down on a $548,000 house, and that would be, $55,000 in round figures, or realistically, they could put $60,000 down on a $600,000 house and still qualify for a conventional loan. And since the minimum on this product is 50,000, I would say that in most cases, people would be putting at least 10% down and maybe upwards of 20.
Perfectly explained. Thank you.
You're welcome. And because it's a 680 minimum credit score, they would almost certainly qualify for a conventional loan with the large down payment and the 680 credit score.
Now this is the bridge loan, right? Where you're selling your house and you're buying a new one and you use that.
That's exactly right. Yep. So this is, we've got a lot of clients who they've got good equity because they bought a home, say 3 or 4 years ago. The market's gone up 50% over the last 4 years. And so they may have $100,000 of equity in their home or more, but they have very little money in savings. And so the whole point of this product is to be able to allow you to write a non-contingent offer for them, rather than having to write an offer that's contingent upon the sale of their house, or for them to avoid having to move twice because they have to sell first and then go find something to buy.
Now does this also get included in their DTI?
So I'll go back a slide. So there's 2 versions of it.
Okay.
There's a debt qualifying version and an easy close version. If their current home, so let's kind of, I'll walk through an example because I think it'll make a lot of sense. They go out and they go shopping and they find a home that they're going to use this product on, and it's a 30-day close of escrow. So long as you list their home and you get an accepted offer with a contingency release anytime prior to close of escrow, then we don't have to include any payments in their debt to income ratio. And when I say any payments, I mean their current first mortgage or the bridge loan in their qualifying. So we can qualify them as if they don't even own that other house from a payment standpoint.
So
That's
would
for the
you also
easy
be
close?
would you also be the one who is providing the loan on the next house being purchased as well, in addition to the bridge loan?
We would, and that is one of our requirements. So we would require, as part of getting the bridge loan, that we're doing the financing on the new loan. And the thing to understand is the bridge loan product for us is not something, I don't get paid on it. And Summit doesn't really make much. They're just trying to kind of run it, without losing a bunch of money on it. The idea really is to use it as a tool to generate new purchase loan business. So that's the main goal for us, is to get the purchase loan on the new house.
So if we were to go to you with the intent in which we're going to sell, they're out there shopping for a home, would you be able to do the qualification that allows them to be at a 21-day close because all you're looking for is the property address? This bridge loan will suffice the in-between?
We could potentially,
even work?
If it's a 21-day escrow. So
and the reason I say that is so if we go and we're going to look at the house, it's nice if we're able to say that we can close in 21 days, right?
Absolutely. So
rather than 30.
This product, if they were doing the debt qualifying, I don't think there would be any issue with the 21-day close. If they want the easy close option where there's no debt qualifying, remember, for that option, they would have to get their home in contract and get the loan contingency removed. So, you would have to determine as the agent if you think it would be possible to get their home in contract without a loan contingency within 21 days. And so long as that's the case, then yes, we could close it within 21 days. Does that make sense?
Yes, it makes sense.
Okay.
There's a lot of spinning around, but yes.
Yeah, I would say if they're wanting to use the easy close option, 30 days is probably better. And keep in mind what you're working around in this case is what you're comparing it to is having to write a contingent offer upon the sale of their house, right? So a 30-day contract not contingent is going to be a lot more attractive than a contingent offer of any sort. So that's really where the big win is, more so than shortening it down to 21 days. If they want to shorten down to 21 days, they would definitely need to be able to do it, I would say, with both, carrying both payments.
Okay, thanks.
You're welcome. All right. So the next program is the Manufactured Home One-Time Close Construction Loan, or the OTC product for manufactured homes. I've got a video here. I'm optimistic that you all will be able to hear it. If you can't hear it, please let me know, because I know it's kind of weird when you're doing these via Zoom. So I'm going to play this video and then let me know if you can hear it.
Summit Funding Inc. introduces our one-time close program.
Can you guys hear that?
It's low, but we can hear
It's
it.
low. Yeah,
Okay.
it's low.
Let me see if I can turn up the volume a little bit then.
Thank you.
Program designed just for manufactured homes.
Is that better? Okay, perfect.
Whether you're a dealer, realtor, or buyer, Summit Funding is here for you every step of the way. As one of the top mortgage lenders in the nation, Summit Funding has developed a special team of professionals that work hard to arrange special financing so you can purchase your very own manufactured home. Typically, manufactured construction loans are financed through chattel loans. With a chattel loan, the home is not permanently affixed to the property and does not have a permanent foundation. Therefore, the home is not considered real property and can only be financed through private lending resources. Chattel loans typically offer shorter terms with higher rates, and standard mortgages cannot be used. You cannot claim homestead exemption with a chattel loan, and you will pay personal property tax and property tax. So what sets Summit's program apart from the rest? With our one-time close program, you can finance your home using a standard 15-year or 30-year fixed loan to combine financing for the lot purchase, construction, improvements, and permanent mortgage. Summit offers competitive rates allowing for lower monthly payments. You can claim homestead exemption on your property taxes, and you will not pay personal property taxes on the home. How do these two options compare? If you were to finance a $250,000 home using a chattel loan through private financing, your interest rate would be around 10% over a term of 22 years. Your closing costs and fees would total to $12,500. Your total mortgage payment, including taxes and insurance, would be $2,950.85 per month. By using Summit Funding and financing this $250,000 home through a government-insured or conventional loan, your interest rate would be 4% over a term of 30 years. Your closing costs and fees would total to $11,000. Your total mortgage payment, including taxes and insurance, would be $2,075.88 per month. By financing this $250,000 home through Summit Funding, you would save $1,500 in closing costs. You would also save $779.94 per month on your mortgage payment. This is a savings of $9,359.28 each year, and a total savings of $192,792.88 over the life of the 30-year loan. By using our one-time close program, you will not only save money on closing costs and your monthly mortgage payment, but you can also purchase your home for less money down. Through chattel loan financing, typically the buyer must purchase the home, purchase the lot, pay to set the house upon the foundation, and pay to hook up electricity and sewer to the home. Although some of these items can be financed, it can cost the buyer upwards of $100,000 in cash. With Summit's program, you can put as little as 3.5% of the purchase price down. For example, on a $250,000 home, the total cash needed for your 3.5% down payment is $8,750. In addition to the low down payment, closing costs can be paid for by the dealer if negotiated into your contract, and if you already own your land, you could close on your home with zero money out of pocket. So, how does our new one-time close program work? Step 1. Meet with a Summit Funding loan officer to get pre-approved for your home loan. Step 2. Meet with a dealer, choose your new home, and find a lot. Step 3. Your paperwork is reviewed by your Summit loan officer. Once we receive the builder contract, the home builder goes through our approval process. Step 4. Your loan is structured, reviewed, processed, and underwritten by Summit. Step 5. Once you receive your approval letter and commitment agreement, you will sign all documentation. Step 6. Then the construction loan closes. Construction begins on your new home. Step 7. Construction is completed. Here, municipality issues a certificate of occupancy, which certifies your new home was built per building codes and other laws. Step 8. Your loan is finalized and modified into permanent loan terms if necessary. Additional documentation may need to be signed. Step 9. It's time to receive your keys and move into your brand new home. With our one-time close program, your homeownership dreams are within reach. Purchase your manufactured home for less money down and save big on monthly mortgage expenses at Summit. Reach out to your local Summit Funding loan officer to get started today. Summit.
All right, so that video does actually a pretty good job of kind of giving an overview of the product. I want to give a few small details about it. So first off, it works with all of our regular loan options. So FHA, VA, and conventional loans all apply for this product. So and the regular down payment requirements basically apply too. So FHA is 3.5% down, VA 0%, and conventional 5% down on this program. Kind of the order of how this would work. So the key part for you as the agent would be helping the borrower find the lot. So they'd have to pick out their land, and then they would want to write a 90-day contingency into the contract to do their due diligence. So due diligence is everything from, due diligence on the land, making sure it's, got electricity hookups and well, or finding out what's involved in getting those on there. Also finding their manufactured home dealer that they're going to buy their unit from. So those are kind of the big pieces there. The average build, and we can build on, this can be done on land that people already own. So if somebody has land that's in their family and they would like to do, a brand new manufactured home on it, this would work great. And the equity they have in the land that they already own would be the equivalent of their down payment. So in that case, they would need no down payment because they already own the land. The average build is about $250,000 to $300,000, depending on what someone wants to build. It's definitely possible to do it cheaper, although most likely people aren't going to get the cheapest manufactured home, especially with where land prices are today. It tends to make more sense for people to get something. There are some fairly nice manufactured homes and larger manufactured homes that they can get now. But certainly if somebody wanted to be less than that, this will go all the way down to a single wide manufactured home. So, I mean, you could spend less money, but on average, you're looking at $250,000 to $300,000, not including the land. There is a 680 minimum credit score. Two big caveats. There's no jumbo loans on this. So 548, 250 is going to be your max conforming loan amount. And then there's no down payment assistance. So we can't combine it with any of the down payment assistance programs that we normally use. As far as the interest rate, so there's two interest rates to be aware of. There's what's called the permanent financing. So once the house is, the manufactured home is built onto the permanent foundation there, or attached to the permanent foundation, the landscape is in and the borrower is ready to get their keys, they're going to have permanent financing at that point, and the rates are going to be very similar to your standard FHA, VA, and conventional rates. There's a small add, but it's not significant, maybe 1/4% off of whatever the going rate would be. However, during the construction process, while we're doing draws for land for the manufactured home company, for the contractor who's doing the install, the rate during that period of time is 8.99%. However, they don't have to make payments. That is all kind of rolled into the closing costs. This program is for owner-occupied purchases only, and it is one unit on the lot. So they can't have two manufactured units, or this isn't for a piece of land that already has a home on it. They want to add this in addition to it. So it's one unit on the lot, and they must own the land. So this doesn't work in a park, for example, where they're renting a space.
So then you could do, if because of where I'm at, if they had a home, mobile home for like 140,000, that would work for this. And if that were the case, when you're saying it's 3.5 to 5% down, when we do like a residential purchase, they also have an additional 3% for the closing costs. So besides the 3.5 to 5% down, they also have to cover the cost of closing, correct? And is that about 3%?
Yes, that's all pretty accurate. The closing costs are going to be, depends on the ultimate sales price, but 3% is probably a safe number to use. It might be a tad less than that. And closing costs, just like any other purchase, you know, if they're buying the land from somebody, could be paid by the seller of the land. And if they're, you know, they can also be paid by the dealer that they're buying the manufactured home unit from. So it is possible to get those covered by one of the other parties in the transaction.
And then you were saying, I'm not looking at that screen again, but I think it was 8 point something in regards to the 8.99 current rate during December. And then you also mentioned that these no payments made, and that they would be included in closing costs. So that could change how much they need besides just 3%. If you get where I'm going with that?
Yeah, I'm sorry. It's actually included in the loan.
Okay, that makes sense. Thank you.
Thank you for clarifying that. Yeah, it's included in the loan, because the loan on the construction, the loan amount is going to be based on the all-in cost of the construction, and the interest on the construction loan is considered part of the all-in cost of the construction.
So if someone's purchasing land, and mention if you're still trying to assess even the cost of putting sewer, putting in a well, putting in the electricity, does the loan assist with covering that cost?
That's a great question. And actually, I'm not sure. I think the lot has to have well and electricity on it. But let me get some clarification on that, because I'm not 100% certain on that. So
from what I've understood in the past, if you're going to purchase land, and then, you know, the modular might be an option or a home to put on it, but whenever you're purchasing land, I believe that they have to come up with 50% down to purchase land.
So the good news on this program is the land purchase can be included in the program. So you can purchase the land with the 3.5% down or the 5% down as well. So that's why we do the 90-day contingency period on the land purchase, so that we can get all of the costs figured out during that time. And then we'll actually finance 96.5% of the land purchase, or 95% of the land purchase, depending on program.
Now that's incredible, and the first time I've heard this.
Yeah, that's probably the most unique part of this, is the fact that we finance the land with the low down payment as part of the whole process.
Is this first time home buyer, or can you have another home and want to make this home your primary one?
So long as this is your primary home, you would be eligible. Of course, it has to make sense, right? You know, if someone's got a big, beautiful home and then they're saying they want to move into a smaller manufactured home, that probably doesn't make sense. But if they truly are moving into it as their primary, there's no issues with that.
Right,
Like-
becomes lease their prime or their home at the time. And now for the 1 unit on lot, I know there's, you know, lots of parcels out there that allow, you know, within a certain acreage, 1 home, but your lot might be like 8 acres or so. Is that still apply, only 1 unit per lot, or would they, you know, have to break up their lot in order to do this if they owned a really large lot?
It is 1 unit per lot. However, as far as acreage goes, we'll allow up to 20 acres with it. So
Okay,
a lot size can be anywhere from, you know, a few thousand square feet up to 20 acres, but it can only have one home, whether it's a stick built or manufactured. It can, you know, you can't have another manufactured on it. You can't have another stick built. It has to be just the manufactured that we're financing.
So if the land has sewage, water, and electricity accessible to one part of the land, but where you want to put the modular home, it is not, is that something that, I think Valerie kind of touched on this, does that have to be in place, or does it just have to be accessible for this to work?
I believe it just has to be accessible because we're financing in the construction costs as well. So obviously the, you know, the movement of those from across the property has to be accounted for in the construction costs. But that's all of that piece is okay to do. What I'm not sure about and what I need to check on is if there's nothing on the property and all of it needs to be put in place. And the reason that I'm uncertain about that part of it is because the timing of doing all of that and the cost of doing all of that is different. And so I'm not sure if it would, specifically the timing piece, I'm not sure if it would meet the timing piece of the process. If it all had to be, you know, added on, because you're kind of dependent upon whatever the municipality is that's responsible for, you know, bringing electric and so forth out to the property. And so, but if it's anywhere on the lot, you can definitely pay for the construction costs of bringing it, you know, through the lot to a different location on the lot.
Okay.
I
thank
know
you.
a lot of the, I'm so sorry, finish for it.
Oh, no, I was just saying thank you.
So I know a lot of the properties that are up here in the mountains by me, all the electricity, you can see the posts that are already there or whatever you would call that. And, but they may still, but septic and water would be something that would still be in question, but power being there already might be something that takes the longest timeline to get there. So with electricity being in place, I don't know how long it takes for water to get somewhere.
Yeah, they'll allow a well on the property. What I'm not sure about is if they will finance the, you know, the digging of that well, or if the well has to already be there. So I will get a little bit of information. And if, does everyone know how to use the chat on here?
yes.
If you don't mind, if you could just really quickly type in your name and email in the chat, I'll make sure that I get information to everybody on here about, you know, if it's a lot that doesn't have, whether it's electricity, water, or sewage, how that affects it, and, you know, what can be financed in and done during the process versus what has to be there before we start.
Really quickly, now I know in new construction you have to follow the new green laws, and that includes like solar. Does that apply for this new modular home?
That is an excellent question, and I do not know the answer to it, but I will make a note of that and find that out. Does it apply to manufacturer? Yep, I will get an answer to that question as well. Any other questions on that program?
Blake, I had messaged you a question.
Oh, okay, let me see if I can see the messages. So this program, it won't allow a manufacturer to go on a property that already has a home on it.
Got it. Thank you.
I'm sorry, repeat that. Somehow I either got my volume that went lower or something happened where I'm not.
Oh, yeah, no problem. Violetta had asked if it could go in the backyard of a home, you know, in the county, because now the county's allowing these accessory dwelling units and so forth. But our guideline on the program is that you can't put one on a home that already has a property on it. It has to be the only home.
On a property that already has a home.
Exactly. Yeah. Oh, is that what I said? Yeah. A home that already, yeah, a property that already has a home on it. This can't be a second dwelling on a property. It has to be the one and only. All right, perfect. Well, I will move on to our bonus programs. Let's see here. So a new program that this is an Eagle team specific program. So this is not a summit funding program, but this is an EMD guarantee program for clients who want to write non-contingent offers. And when I say non-contingent, in this case, I'm talking about no loan contingency. And in some cases, no appraisal contingency, but that's kind of on a case-by-case basis, depending on their down payment and so forth. But basically, we will guarantee up to $5,000 of a borrower's EMD money, meaning they could release that immediately if they wanted to, so long as it, you know, wasn't subject to any additional contingencies besides the loan. We pre-underwrite the file, and basically we guarantee our underwriting of the file against any changes. Obviously, we're going to be a little bit more thorough with that than maybe we would on a pre-approval for a borrower where we're not making this guarantee. We want to do our best to stand behind everything, but we get those requests where, you know, we need a pre-approval letter immediately to go see a house or to make an offer on something, and the documentation we've gotten is a little bit incomplete from the borrower, and sometimes we'll make a judgment call and still issue that letter. That would not be a scenario where we would do it with a $5,000 guarantee, but so long as we've had an opportunity to fully vet the file and get all the paperwork, we will guarantee not just that you can write with no loan contingency, but that your deposit, your borrower's deposit of $5,000 is guaranteed. If anything goes wrong, doesn't matter. Anything that we miss, the only thing would be fraud. You know, someone forged a W-2 or something, that would kind of be on them. But provided there was nothing fraudulent, we would guarantee that $5,000. And then if the appraisal piece, we would make a judgment call on the appraisal piece as well, depending on the borrower's circumstances. So obviously borrowers who are putting minimal down payments down, there's not a lot of flexibility to guarantee their appraisal, but we do have some programs for borrowers who are putting, you know, 10 to 20% down, where we can still guarantee the appraisal up to a certain amount because we have some flexibilities if it comes in low with how we handle the loan. So that is a new program as well. We do have some marketing stuff on that, so I'll get that out to everyone on the call as well, if that's something that would be helpful for you. Does anyone have any questions on that? Okay.
So I'm sorry, this is in reference still to the same program we've been talking about. This is not another one, correct?
This is a new program. So this is just a loan guarantee program for any buyer that you have. Basically anybody that we've pre-approved, so long as they're willing to go through a very thorough pre-approval process where we can pre-underwrite their file, then they can write, and it doesn't matter the loan type, VA, FHA, conventional, jumbo, et cetera. They can write with no loan contingency, and they could release their deposit immediately if they wanted to, because we would personally guarantee their deposit up to $5,000.
That's awesome.
So the idea is just to make it as attractive as possible to a seller. One of the things that we've seen is we've seen a lot of people removing contingencies, but leaving, you know, one piece of the contingency in there, and sellers have kind of caught on to that. It's like, hey, you're saying you have no appraisal contingency or no loan contingency, but yet you still have a 14-day inspection contingency. And they've kind of caught on to the fact that people are kind of using that time period to try and figure out the rest of the things. And so in a situation where you could release your deposit immediately and write with no contingencies, it gives the seller that extra, you know, layer of assurance that, hey, this thing's for real. They're releasing their deposit right off the bat, and they're writing with no loan contingency.
And this, with that being thoroughly vetted, could be a 21-day close, I would think,
Absolutely.
right?
Yep, absolutely.
Okay.
A 21-day close. All right. And then the last one, our last bonus program. And this is actually something we've had for a little bit, but I think it applies more now, and not a lot of people know about it, is our temporary interest rate buy down program. And this is great for borrowers who are well qualified, but have just gotten discouraged a little bit by the prices and what it's done to payments. And so what we've seen is people, they're well qualified, but they're just feeling like, hey, my budget really was $2,200, and for me to get what I want, I've got to be at 24, 25, 2,600, and it's just more than they're willing to stretch. And so the way this program works is that it comes with a first year rate that is 1% below the permanent rate. And so I threw an example on here. You know, if you had a 30-year fixed rate of 3.25%, on this program, your year one rate would be 2.25%. And so on a $400,000 loan, that's the equivalent to about $211 a month for the first year that they're in the home. And it's the equivalent of about $30,000 to $40,000 in purchasing power. So, you know, it would be the same payment as if they got a $360,000 loan at 3.25% for the first year. And usually how we explain it to borrowers is that most people get a 3% salary bump each year or close to it. And so if you're making $100,000 in household income and you get a 3% salary bump, that's $3,000 a year, which is $250 a month, which is, you know, more than this $211 that your payment would jump after year one. So it's a way to say, hey, let's get in the house now before the prices go up even higher. We'll get you the lower payment. And then in a year, your payment will go up a little bit, but so will your salary. And you'll have been in the house and built some equity by that point.
So this isn't an adjustable, is it?
No, it's not an adjustable. The rate is fixed for 30 years at 3.25%. It's just a promotional rate for the first year to help them have a lower payment for the first year they're in the house.
But
Does this apply to all the loan programs, like, you know, just regular FHA, conventional, VA?
It does. It doesn't apply to jumbo loans, but it applies to everything else.
okay, so these numbers that we're seeing, they're not actually factual either. We're going with the first year rate is 1% below the permanent rate. So if the permanent rate right now is say 4%, then the first year it would be 3, and then years 2 through 20, it would go back to what current rate is at 4%.
No, we lock in the permanent rate as well. So if today's rate is, and these, I pulled these rates, they're roughly where rates are today. Obviously, it depends on credit.
Can you just change your explanation of using the numbers using like a 4%, just so I can see the difference here, and that might resonate better for me?
Yeah. So
that number, like if it were,
if the loan amount were 400,000 and the rate today was 4%, so 400,000 loan amount, 4% interest rate over 30 years, that would be a monthly payment before taxes and insurance of $1,909. However, for the first year, they would be at 3%, which would be a monthly payment of $1,686. And so the savings between those two would be $222 a month. So it would actually, on higher rates, it's actually a little bit more savings than it is on the lower rates. But basically on a $400,000 loan, kind of regardless of where the interest rates are, you're going to be saving at least $200 a month for the first year.
Okay, so then how do you guys recompensate for that gift you've given in the first year? Does it get added to the back end, or you're just willing to give 1% less than current rate and then go back up to current rate after starting year 2 through 30?
It's a promotional program that we're doing. So there's a couple of ways it can be covered, but right now we're running it. So traditionally, it's supposed to be covered by the seller. Like you're supposed to get a seller credit. Obviously, in today's market, that's not happening. So we're running it as a promotional program right now where we'll credit it.
These are all like conventional owner occupied.
This particular program is conventional FHA or VA owner occupied.
And can that apply to 1 to 4 units? The normal
1 to 4 units, so long as it's owner occupied.
Okay.
That just sounds like, I mean, anybody would be able to take advantage of this because you could get year one at 1% less than current loans are at. And yeah, I could, like, if the buyer is capable of paying current rate, they'd still have this kind of a gift of an option to reduce it by 1% and use you guys.
Absolutely. Yeah, it's a great program for anybody. It's a tool for people who are really stretching, but it's obviously just kind of a great little bonus for those who maybe would be fine either way.
So this can be a 3.5% down, 3% closed buyer, correct?
You could. Yeah, the only
I don't know if you have what might be coming next, but do you have programs that help with down payment assistance?
So we do. We have a couple of different programs that help with down payment assistance. I didn't build that in because they're programs we've had for a while, but we actually do quite a bit of down payment assistance. I would say we do, I don't know, at least a couple every month. There's two main programs, one through Golden State Financing Agency, GSFA is the abbreviation there, and then one through the California Housing Finance Agency, which goes by Cal HFA. So, and there's within those, there's some little sub programs for, there's a teacher program, and I think another program for, law enforcement in certain areas. So those are definitely programs we have. I didn't put them on the slides just because I didn't want to keep everybody too long, but if that's something that people are interested in, I would be happy to do a presentation on that as well. So if you've got other topics, and that's because this is kind of the end of this particular presentation, if you've got other topics that you would be interested in seeing in kind of a future, product presentation, let me know, and I would be happy to put together a presentation on down payment assistance programs or, anything else that people have questions on.
So if I have a client that's out here and they are interested in buying land, and the program you have only is to put a modular on it, not brand new construction.
Correct. New construction is kind of a different animal. I do have a contact that would do new construction, but it's more what you've kind of seen typically, which it's going to be a 20 to 30% down payment, on the land and on the construction costs. So part of the reason this works with the manufactured homes is because the manufactured homes are already built. So it's just an installation of that. There's a foundation that has to be poured, but then it's just an installation of the home. The problem with regular construction right now is, especially with custom construction, you're probably looking at 8 to 12 months, build time on a lot of those things. And so it's a longer process, and we don't want to be involved in the construction loan process for that kind of time period.
Okay, so I have a client who may be interested. There's an option in which to purchase land, so what she's after is she would like to create a business opportunity that allows her on that land to have like weddings there. Like maybe the land is beautiful and they can have weddings and such. Would they be able to put a singular modular home on it if they're going to be owner occupied and still have a business opportunity available to them?
So long as they're going to live in the home, the modular home they put on it, then we wouldn't have any issues. I'll be honest, I probably wouldn't volunteer that they want to use the land for weddings. But there's nothing that we wouldn't keep them from doing that after they owned it, so long as they're living on the property, and not trying to build any of the wedding buildings simultaneously, right? If they were trying to build some sort of event center on the property or banquet hall on the property while we were going through our process, that would be a problem. If they wanted to do that after the fact, we wouldn't do anything to stop them.
Yeah, it would have to be in the correct type of zoning that allows them to have that opportunity as well. So
Yeah.
thank you for that.
Yeah, no problem.
And then when you mentioned the Golden State, I don't know if that's because we've been working with a company that offers a program for the firefighters, teachers, and first responders, 5% grant program. I'm just wondering if the name you mentioned sounded like that's the same company.
It may be that program. The Golden State Financing Agency does up to a 5% grant. So for qualified borrowers, they have to meet certain credit score and debt to income requirements, and they have to be, well, they don't have to be first-time home buyers, but they can't own another property. And they will do up to 5% on a grant and another 2% on a loan with that particular product for borrowers that meet the credit score requirements. So that could be the same product.
I'm just gonna look something up, but don't leave, but keep talking.
All right. While she's looking that up, does anyone else have any other questions about any of these programs or just anything in general? No? All right. Let me see. I see some stuff in the chat, so let me go down to the bottom. Okay, we got a request for down payment assistance. Awesome. Well, I don't want to keep everybody. I will stay on to answer any questions that anybody has, but I do want to say thank you guys very, very much. I see all the emails in here, so I will respond with some information on unfinished lots and how we handle that, and then also solar on the manufactured homes and how that gets handled. If you guys need anything else about any of these programs, or you think you have a client for them, or you want some marketing material, please reach out and let me know, and I will be happy to get that stuff to you guys. And in the meantime, for anybody who wants to stay on, I will be here. For those of you who are ready to go to lunch, I totally get it. And thank you all for joining.
I don't know if I missed it a little earlier, but if you could mention again in reference to, I know they asked the question about solar being mandated for new construction, and I don't think I paid attention enough to hear. Is it also mandated for the manufactured homes too?
It was one of the questions I didn't know the answer to. So it's going to be part of my follow-up that I send out. I'm going to find out.
Wonderful.
All right. Valerie, did you have an additional question you wanted me to hang around for?
I'm just kind of trying to work in my mind about being able to purchase land, you evaluating the correct pricing for the land, and then putting a modular on there so that, you know, like it could be listed for something, but in these remote areas, you don't know if that's an appropriate assessment of value.
Right, and that's a great point. So the way that we're going to ultimately determine, you know, the sales price or the what we loan based off of is the all-in cost of the project. So if your client
And whether or not that's comparable for the area. Once we have this land and this home, that's an approximate correct value for others selling currently, or right? Something like that.
Exactly right. So I'll kind of walk through one. Let's say you find the land and the land 50,000, and we have a manufactured home dealer who will do the unit plus install for 250,000. So now we're up to 400. And let's say there's another 50,000 in soft costs, you know, interest on the construction loan, maybe some permit fees, et cetera. So the total is 450 with the manufactured home, the land, and everything all in. What we're going to do is an appraisal that basically, once we calculate that number, we're going to order the appraisal and say, hey, appraiser, go out and tell us if this 450 number, based on these, what we're going to put on the property, is in line with the rest of the area.
Yeah, because getting 1 acre, 1.5, or getting 20 or 80 acres is a different number for the land.
Yeah, they would factor in the acreage for sure. I mean, there would definitely be acreage adjustments on the appraisal. So, you know, they would, is it a 1 acre? Is it a 5 acre? 20 acres are max. So, you know, we wouldn't be going above 20 acres, but there's definitely a law of diminishing returns on the acreage as well, you know.
So only up to 20.
Yeah, only up to 20.
So Blake, I have a question that I probably already know the answer to, but just like recap. There is, do you offer any programs to construct an actual home and not a manufactured home? I know it kind of falls into more like a hard money type of loaning or lending, but is there something new out there that I haven't heard of?
So we don't. A lot of that gets done via hard money. Central Valley Community Bank is actually who I would refer people to first if they were looking for that.
Yeah, I spoke to them.
But they've got some pretty, I mean, they're really doing that for kind of the a paper person who's building their own home, not so much the investor who, you know, is going to
Right.
it, right? So if you've got that investor client, which is obviously a great client for you guys because they're going to do this more than once, their hard money is usually the best way to go. And for a couple of reasons. Obviously, the costs aren't great and the rates are pretty high, but it's usually short term. There's very little restrictions in terms of, you know, for the whoever the builder is, less licensing, less approval processes, you know, less particulars when it comes to getting their draws and so forth. And so they tend to be able to build and flip those houses a lot faster than if they went through a more structured institutional, you know, construction loan process. And the credit piece is a lot better. The credit piece is a lot easier because the other thing when you go through like Central Valley Community Bank, you're looking at, you know, high credit scores, you know, and things of that nature. Whereas I find a lot of times the people that are flipping these houses don't always have great credit, but they've got a lot of, you know, cash, big chunk of cash and so forth. And so with hard money, they'll do it with not much of a credit check.
Can I ask where you're located?
I am located in Stockton. So I am right off of I-5 and March Lane in Stockton. Technically we're on Deer Park, but right off of I-5 and March Lane.
Okay, so you're over near the office, near our office.
Yeah.
If you've done this program, I have a client who's been interested in Morgan Hill and Gilroy. She would consider I would think she'd consider a modular if that were an opportunity. I haven't looked at land for her because I wasn't aware of, you know, it was 50% down for a modular prior to speaking to you. So that was never going to be an option. But do you have any mobile home? Do you call it a mobile home or do you call it a modular?
We call it a modular manufactured, where I would call it a mobile home as if it's at a park where they're renting the space, you know, renting the space.
Thank you for the clarification. So then if you've worked with this program before, do you happen to have the modular builders that would provide a home into the Morgan Hill and Gilroy area so I can assess what those prices might be?
So I don't, but I will track some information down on that. I will find our list of approved builders. This program.
And do your how far out would your builders take a home would be my question. Like if you've got some local in Stockton, would they deliver it too?
So that I'm not sure about. We'll do the program anywhere. I mean, I can do it anywhere in California. Summit also has it available in a handful of other states as well. So, but yeah, it's just a matter of finding a manufactured home builder in that area. So what I can do is get a list of those that we've already approved. If there's someone on there that would build in that Gilroy area, great. If not, the other option would be, you know, to find a couple of builders in that area. And when I say builders, I really should say dealers, manufactured home dealers, because they're having these units built ahead of time and then selling them more like cars.
Right. And then they carry them on a truck to take them wherever they're going, right? With a wide load coming. So I'm just wondering too, that if you're purchasing one in Stockton, perhaps that supplier may have a lower price than the one who's manufacturing it in Gilroy
Yeah,
and Morgan.
that's a good point. It seems like everything is a little bit less in the valley than it is in the Bay Area. There's some kind of automatic markup as soon as you go over the hill. So the question would just be, you know, does the travel cost, you know, how much is that compared to the savings you get on being able to buy the unit cheaper? And so
Yeah, I had to use pods before, and then we didn't discover until we were moving that, oh, they will not take the pods across the Altamont. So I don't know if that would be the same kind of issue of travel for a
I'm
dealer.
not 100% sure, but I will find out. So this is a new program that we literally just rolled in the last couple of weeks. So it is new to me too. I think it's a great program, which is why, I mean, we sometimes roll some other programs that I don't go out and promote, but I really think this one's kind of cool and unique. So there's a little bit of learning curve on my end. So I will track down these answers though.
Wonderful.
All right. I see there's a few other folks on. Do you guys have any other questions for me? All right. Well, with that, I will let everyone head off and enjoy the rest of their Wednesday. Thank you guys so much. I'll be sending out the rest of that information, but if you think of something that we didn't cover, please feel free to reach out to myself or to the team. We'd be happy to get you guys answers or information.
If you happen to have a flyer pertaining to the first responders, firefighters, teachers grant program, I'd like some information coming from you on that too, please. And this would be for the Gilroy Morgan Hill area.
All right, I'll put that on my list. Gilroy. Perfect. I will get that out too. Thank you guys.
Thank you. I think I'm the last. Oh, no, there's still 4. Bye, everybody. Have a beautiful week and a nice weekend.
Bye, Glenn, and bye, Misty.